Greetings and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where our focus is on helping business owners and businesses themselves redomesticate out of high tax, business unfriendly environments like Maryland to pro business, pro growth jurisdictions like Florida and Texas. Today, I am covering a report by the Fox affiliate in Baltimore, Fox 45 News, entitled Local Tech Company Say New IT Tax Could Push Them Out of Maryland, as reported by Rebecca Pryor. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi state, multi attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, together with a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications spanning accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Maryland has told its technology sector that it is no longer welcome. On May 20th, 2025, Governor Wes Moore signed the fiscal year 2026 budget into law. That legislation, House Bill 352, included a 3% sales tax on data and information technology services effective July 1, 2025. And we've had almost a full year to see the dramatic effects of that decision. The companies that warned this could happen were not being dramatic. They were reading the math correctly, and the math was frankly not all that complicated. In the report that I'm reviewing, Todd Marks is described as having built MindGrub Technologies in Baltimore for more than 2 decades. When the tax was advancing through the legislative process, he said his company had 1 foot out the door already and was looking at Tennessee, North Carolina, Florida, my personal favorite, and Wyoming. He expressed the problem in terms that any business owner can understand. The tax represents close to a third of his bottom line, and he cannot simply pass it on to his clients because those clients have no obligation to pay a Maryland premium when they can simply hire a company in Pennsylvania or Virginia and avoid the charge entirely. That is how the free market works. That is not a threat. That is simply reality. Similarly, Wade Berger, owner of Ascendant Innovations, a federal contracting firm in Hanover, has been in Maryland for 30 years. He raised his children there. He said he wants to stay. He also said that the tax represents a 624% increase in his company's Maryland tax burden. According to the report, his additional annual tax exposure is approximately $250,000 per year. That is not a rounding error on a small business balance sheet or income statement. That is a material threat to the company's viability in the state, and Mr. Berger said so directly. The legislators who fast tracked this tax gave the industry almost no time to prepare or provide input before the session ended. That procedural detail matters because it signals something beyond the tax itself. We can read between the lines. It signals that the legislature did not consider the industry's response a relevant input into the decision making process. Companies that feel they have no voice in the policy process that governs their operating costs reach a predictable conclusion. The process is not working for them, and the time and capital would be better deployed somewhere else. In the same report, Brian Crosby, one of only 2 Democratic lawmakers to vote against the tax, had already moved his own company to Virginia before the bill passed, describing the measure as something that would cripple his business. When a Democratic legislator in a state that has passed this tax moves his company to the neighboring state in anticipation of that development, the signal is rather unambiguous. This is not a partisan critique, it is an operational assessment from someone who understood the numbers and acted on them. Governor Moore's office responded to questions about the tax by describing the governor's investments in quantum computing, cybersecurity training, and technology modernization initiatives as if that explained anything. They don't really have anything to do with the tax, do they? But that's beside the point. Those investments may be genuine and worthwhile, but they do not address the specific problem the affected companies raised. A state can invest in the industries of the future, which they should do, while simultaneously taxing the industries of the present into exiting, which they have done. Both things can be true at the same time, and in Maryland's case, they certainly are. The state projected approximately $500 million in a new annual revenue from the IT services tax. And that projection assumes, you know what they say about assumptions, the taxable base remains stable. Spoiler alert, it has not. That projection does not account for the companies that relocate, the contracts that migrate to Virginia or Pennsylvania or Tennessee or Florida or Texas, the employees who follow their employers across state lines, or the new business formation that chooses not to happen in Maryland because the regulatory and tax calculus points elsewhere. The $500 million figure is a static estimate applied to a dynamic system. Static estimates applied to dynamic systems have a consistent track record of overstating revenue where the underlying base is mobile, as is the case here. Maryland sits in one of the most competitive regional economies in the United States, if not the world. Virginia is not a hypothetical alternative. It shares a border, draws from the same federal contracting ecosystem, and has made deliberate decisions to position itself as a tech-friendly destination. Pennsylvania is a short drive from many Maryland businesses and residents. The companies Marx and Berger described are not contemplating transcontinental, there we go, relocations, requiring years of planning. They are contemplating moves to adjacent states that take weeks or months, not years, and that are well within the operational capacity of small and medium-sized technology firms. What is particularly notable about this situation is what it reveals about the anatomy of a business relocation, also known as a redomestication decision. The businesses being pushed out of Maryland are not the household names that generate press releases and substantial media coverage when they move. Rather, they are the 10 or 20 person software development firm, the 50-person federal contractor, the solopreneur fintech startup company. The list goes on. These businesses do not announce their departures. They don't hold press conferences. They simply do it. They change their registered addresses, notify their employees, and begin hiring in the new jurisdiction. The revenue they generated disappears from Maryland's tax base without a headline, and the projections that assumed they would stay to begin with begin to diverge from reality and actual tax collections. The pattern we are seeing across California, Washington State, Washington, D.C., New York, and Maryland is not identical in every state, but the underlying structure is consistent. A jurisdiction facing a budget gap identifies a category of taxpayer or business that appears, at least superficially, to generate large concentrated revenue and proposes a tax on that category. The tax is projected to produce substantial new revenue. The affected category, which by definition has the economic capacity and incentive to respond behaviorally, begins to do so, as you would predict. The departures are initially dismissed as isolated or overstated. The revenue then falls short of projections. The budget gap is either unchanged or wider than before. Maryland's technology sector warned the legislature this could happen. One of the legislature's own members moved his company to Virginia to demonstrate that the threat was real. The governor signed the bill anyway. The tax is now law. If your technology company, your IT services firm, or your data services business is domiciled in Maryland, the question you need to answer is not whether the political environment will soon improve before the next budget cycle. Rather, the question you should be asking is whether the cost of staying put, measured in real dollars against your actual bottom line, exceeds the cost of moving. For a company facing a 624% increase in its state tax burden, that calculation has a real answer. The only remaining question is how long the company waits before acting on it. Money goes where it is welcome. Maryland has made its position clear. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this process and to schedule time for us to speak about your specific situation. Again, my name is Chad Cummings. Yes, I'm real. No, I'm not AI. And I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice because legal advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations on these topics, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.